There is something unusual happening in the market right now. Risk appetite has not completely disappeared. Equity markets are still showing resilience. AI-related stocks continue to attract attention, and investors are still willing to chase growth when the story is strong enough. But Bitcoin is not fully participating in that same enthusiasm, and that is what makes this moment important. If the market is still willing to take risk, why does Bitcoin look weaker than expected? Why does it feel like capital is still active but not flowing into crypto with the same conviction? This video is not about saying that Bitcoin is broken, or that crypto is finished, or that one asset class has permanently defeated another. That would be too simple. What we may be seeing is more specific and more useful to understand. Capital rotation. The market may not be rejecting risk completely. It may simply be choosing a different kind of risk. Right now, that different kind of risk appears to be AI, large-cap technology, and the parts of the equity market that still have the clearest growth narrative behind them. That distinction matters because if Bitcoin were falling simply because every risk asset was selling off, the interpretation would be straightforward. But if Bitcoin is lagging while other growth assets continue to perform, then the message is different. It suggests Bitcoin is not only dealing with price pressure, it is also dealing with an attention problem, a momentum problem, and a capital allocation problem. In other words, Bitcoin may not be losing because the entire market has turned bearish. It may be losing because the market has found a stronger short-term story somewhere else. This is where capital rotation becomes a useful framework. Markets do not move only because investors suddenly become optimistic or pessimistic. Markets also move because investors constantly reprice opportunity. Capital is always searching for the strongest story, the clearest reward-to-risk setup, and the asset with the most convincing path to future upside. When one theme becomes crowded, exhausted, or temporarily uncertain, money does not always leave the market completely. Sometimes it simply moves to the next theme with stronger momentum. Right now, Bitcoin may be facing a relative problem, not only an absolute one. Even if Bitcoin still has long-term appeal, other assets currently offer a more immediate narrative. AI has earnings momentum, a clear corporate spending story, infrastructure demand, data center expansion, semiconductor leadership, pricing power, and constant media attention. Large-cap technology benefits from liquidity, but it also benefits from visibility. Investors can point to revenue, capital expenditure, margins, enterprise adoption, and future productivity stories. Whether every part of that narrative is fairly priced is a separate question, but the market understands the story and wants exposure to it. Bitcoin, by contrast, depends more heavily on positioning, liquidity conditions, ETF demand, investor sentiment, and macro interpretation. That does not make Bitcoin weak as an asset class, but it does make Bitcoin more vulnerable when markets demand a fresh catalyst. If the market is asking, what is the next reason to buy Bitcoin aggressively, and the answer is not obvious, then Bitcoin can drift even while other risk assets remain strong. This is why the current weakness should not be viewed only through the lens of price. It should also be viewed through the lens of narrative competition. One of the clearest signals to watch in this phase is Bitcoin ETF flow behavior. When spot Bitcoin ETFs are attracting steady inflows, the market can build a strong institutional demand story. That story matters because it tells participants that Bitcoin is not only a retail trade, but also part of a broader capital allocation process. Strong flows support confidence, and confidence supports price structure. But when ETF flows cool down or turn negative, the message changes. The market begins to ask whether institutional demand is pausing, whether the easy part of the re-rating is already behind us, and whether Bitcoin needs a new catalyst before it can lead again. That is why ETF flows are not just a statistic. They are part of the market's confidence engine. If flows are strong, confidence grows. If flows fade, confidence weakens. And if confidence weakens at the same time that AI and equities continue to offer a more exciting opportunity set, then capital does what capital usually does. It rotates. This does not mean Bitcoin has no future. It means the short-term sponsorship behind Bitcoin may not be as strong as the sponsorship behind AI and large-cap technology at this particular moment. The macro backdrop also matters because Bitcoin does not trade in a vacuum. It trades inside a broader liquidity system where the US dollar, Treasury yields, central bank expectations, geopolitical stress, oil prices, and financial conditions all matter. If macro conditions become even slightly less supportive, Bitcoin often feels that pressure quickly because it sits at the intersection of liquidity, sensitivity, and speculative positioning. In a very loose liquidity environment, multiple risk assets can rise together. But in a more selective environment, markets may not support every high beta asset equally. This is the difficult part of the current setup. Macro does not have to become fully hostile for Bitcoin to struggle. It only has to become uncertain enough that investors become more selective. When that happens, capital tends to move toward the assets with the strongest near-term story. At the moment, AI has that story. It connects technology, productivity, infrastructure, labor efficiency, software demand, cloud spending, semiconductors, and long-duration growth expectations. It is one of the most powerful narrative machines in global markets, and Bitcoin has to compete against it for attention. This helps explain the divergence. The market may still be risk-on, but it is not risk-on everywhere. It is concentrated, selective, and heavily focused on the themes that investors currently trust the most. That is why asking, "Why is Bitcoin weak?" may not be enough. A better question is, why is Bitcoin failing to lead when risk appetite still exists? The answer may be that Bitcoin is temporarily losing the competition for attention, liquidity, and conviction. This is also why we need to separate a weak asset from a lagging asset. A weak asset loses sponsorship because the market has lost belief. A lagging asset loses sponsorship because the market has found a more attractive opportunity elsewhere. Right now, Bitcoin may be closer to the second category. It may not be dead money, and it may not be structurally broken, but it may be in a waiting phase where the market needs a new reason to re-engage. Until that reason appears, Bitcoin can continue to feel heavy even if the broader market has not collapsed. That reason could come from several places. It could come from renewed ETF inflows, improving liquidity conditions, a softer dollar, lower yields, a shift in positioning, or a moment when investors decide that the AI trade is too crowded and begin searching for the next area of asymmetric upside. It could also come from Bitcoin reclaiming relative strength against equities, not just bouncing in isolation. A single green day is not enough to prove leadership has returned. What matters is whether Bitcoin can begin outperforming again when compared with the broader risk complex. So what should we watch next? The first signal is ETF flows, because consistent inflows would suggest that the institutional bid is rebuilding. The second signal is Bitcoin relative to the Nasdaq, because if equities remain strong while Bitcoin stays stuck, the capital rotation thesis remains alive. The third signal is the US dollar and Treasury yields, because tighter financial conditions can keep pressure on speculative assets. The fourth signal is AI sentiment, because if the AI story begins to lose momentum, even slightly, capital may start looking for other areas of opportunity. The final signal is Bitcoin's own market structure. Bitcoin does not need to explode higher immediately, but it does need to stop acting like the forgotten risk asset. It needs to show that buyers are willing to defend key areas, that ETF demand can stabilize, and that the market still sees Bitcoin as part of the next liquidity phase. Without that, Bitcoin can remain relevant in the long term while still underperforming in the short term. For now, the message from the market seems clear. Risk is still alive, but it is not flowing evenly. It is being selective, concentrated, and pulled toward the themes that investors currently trust the most. That is why Bitcoin lags, not necessarily because the long-term story is broken, but because in the short term, another story is stronger. And in markets, the stronger story usually wins first. The final question is not whether Bitcoin still matters. The real question is whether Bitcoin can win back attention before the next liquidity shift changes everything again. This is the calm metrics. If you think this is just a temporary pause for Bitcoin, let me know. And if you think capital rotation into AI is the real story of this market, I'd like to hear that too.